Hello, YouTube. Welcome back to the Wealth Catchers YouTube channel. Definitely glad to see you guys. Hopefully, you guys had a great holiday season and Happy New Year to you all. Definitely looking forward to see what this year is going to bring. And today, we're going to be diving into the 2026 strategy. Don't forget to like, comment, subscribe. And as always, please remember this is not financial advice, it's just for educational purposes. And definitely looking forward to sharing some information with you all. Let's dive into it. So, for this year, I'm personally calling it the 2026 pivot is because of how I'm changing my mind frame about how I was viewing everything. If you looked at the past videos, you can see I was diving more towards into the physical AI. I feel like that's something that I was aware about, but definitely not to the extent and I guess how deep it is in terms of we do need to get that figured out, situated before all this other stuff even comes to fruition, right? So getting our power, getting the power grid situated, getting the infrastructure built out, being able to handle this workload that's so demanding is going to need to be done first. Then we have to worry about the software. Then we have to worry about how these businesses are going to implement it into their businesses. How long would that adoption take? And then just, I guess, opening my eyes to realize how deep and extensive these layers are, and also the time frame that I did mention in the past too, that we're looking at too short of a time frame for all these things to play out. But as we're gonna dive deeper into the video to show you some other stuff, just really just opening my eyes and seeing that this physical AI layer is very crucial. And again, I feel like this is the area too where the most real dollars are put in, as in terms of like these are real companies making real revenue, really breaking ground, real buildings being put up, right? And these companies that we're going to share later on feel like they're going to be big beneficiaries of what's going on down the pipeline. So not going to waste any time with this one, so we can go dive right into it. So I've added 5 new names to the watch list. Again, the watch list is on the website, thewealthcatchers.com. I'll leave the link down there in the description. Every month, usually every first of the month, there's a new watch list that's put out. Generally, it's the same companies that's on there, but I am tracking their prices. I am tracking what they've done in the past month and also do a recap at the beginning to show what has happened during the past month. So definitely some good information, some good insight on where price is at, what's good entry points and things of that nature. Okay, so definitely gonna look into this right here. We got URI, which is United Rentals, and we got CAT, which is Caterpillar. So they've been added to the watch list due to the fact that we're gonna have a mega project boom and record power generation. I think these companies are positioned for this line of growth and these things that's going to happen down the pipeline for us. For URI, they're a primary equipment provider for massive multi-year mega projects. So the key thing that got me in there is primary equipment provider, and these are multi-year projects. So people come to them to rent out equipment, such as you see in this the picture on the side. That's Caterpillar equipment, but URI has their own equipment, just like that. Excavators, anything else for construction, they have those vehicles and equipment as well for companies to rent out. And then again, multi-year. So the people aren't renting out for a couple months. They're renting these for projects that may take 2 to 3 years to pay out. So I feel like that's a good industry to still be a part of. And then they also have rising rental penetration. So again, more people are going to try to rent these pieces of equipment out because it costs so much money to buy these pieces of equipment. And then also, if you are going to choose the buyout route, you're going most likely going to finance it, go into debt just to hold on to that piece of equipment that you're probably going to only use for 2 to 3 years, maybe five, and it's just going to sit there on your inventory. But you're going to probably have to figure out how to resell it, get rid of it. But URI, it plays as that middleman for you to not deal with that. They take on the risk because they have all the machines. You sign a deal with them, you get the piece of equipment, use it for how long the contract is that you need it for, and give it back, and you're all done. And then they also have URI does, especially segment growth, which is a high margin segment for them. So outside of the rental, they do have solutions for power. They do also have a play into the HVAC as well. So, and I think those two. and part of, and also some liquid solutions that's moving up to like a third of their revenue now, about 29% of their revenue, which is very good insight to see that they also have other parts of their business that's not solely relying on the rental equipment. Then we go over to Caterpillar. Caterpillar, again, as the picture shows, you usually them seeing these heavy industrial pieces of equipment, but they also have the backup power solutions for these data centers that are being built out, which a lot of people aren't thinking about or are aware of. I remember years ago, I drove behind a supermarket, I think it was like a Publix, and I saw a Caterpillar piece of machinery sitting there that was attached to the building. At that time, I didn't know what it was, but safe to say it's something to do with the power generation or a backup power, like a generator, things of that nature. So seeing that they have that um, connection to these data centers in that way, in that facet, and along with being able to build out the foundation as well, it's like getting two for one there. And then they also have a record backlog, right? So $40 billion down the pipeline that's already locked and loaded for them. So that's orders already on the book. 40 billion basically guaranteed for them to go out there and do the work they have to go ahead and set up these data centers and these foundations. And then they also have recurring services, which is just people that's going to continuously keep paying them out for the same services that they've been providing over a 1 year, 2 year, 3 year basis, whatever the case may be. But they have 28 billion that's going to be coming in from that segment, that section of their business by the end of this year. So 28 billion locked and loaded there for recurring services. At the backlog of 40 billion is just money's coming in hand over fist for them. Then some more names that's been added to the watch list. We got MLM, which is Martin Marietta, and PWR, which is Quanta Services. So they're doing the groundwork for the evolving infrastructure landscape, and then a lot of it has to do with electrification and construction projects, right? So MLM, and then you're gonna see the play that I had switched it out for. I'm gonna show it later on what names were also kicked off the watch list to add these in there. But MLM, what got me with them is they're the dominant provider of aggregates. So those huge piles of crushed stone and sand that you see at these construction sites, these locations that are being built out, they're the ones that's providing those aggregates. That's what they're called, to these locations. So if you need sand, you need stone, that's who you go to, and they're the ones that's providing these materials and this equipment for highways, bridges, and of course data centers. So being able to have that play, because things are still going to be being built out, regardless if it's data centers or not. They're still going to be in business. The data centers and the fire behind that and the rush behind that just helps boost them, but they're still going to make money regardless, which is again why I'm trying to find plays and find companies that still benefit from AI, but aren't solely reliant on it. And I feel like they're a perfect example of that. And another thing that could kind of be a catalyst for them that I found interesting is they are going to be raising prices. So they have this proprietary pricing model called Precise IQ that they plan on rolling out to their sales agents and to their staff probably mid 2026. And then that tool is just helping them be able to squeeze out more margin and help them improve their pricing models better, just get some more money out of their deals and things of that nature. So we can see after 2026 when they report the numbers, most likely their margins probably went up, depending on how that tool turns out for them. And then we have PWR. PWR have heard of, especially from one of someone I've been following for years. His name's Wall Street Trapper. Heard of PWR from him first, but I never went ahead and did the research and looked into it. But then after seeing it, I think a couple of videos back when I mentioned it, that was me doing more research on it, and then it just keeps popping up, and I'm just like, okay, let me actually pay attention to what's going on here with this. And then every time I go into it, I find something more, I find more information, or I find something new that's just like, I'm like, I really like this in terms of a long-term investment, and especially for being on the watch list. Because again, my watch list is usually isn't something that's for a year or 2 years. Most of those names you're going to see if you go all the way back to 2021 and you go to now, January 2026, you're going to see a good chunk of those names are still the same names that are on there, and you see that growth. So that's usually how I look at it. what could play out over the long term. So PWR could be dubbed as the grid's secret weapon because, again, back to the situation that we do have with the getting power for all this build out, right? There's potentially a 5 year wait on power for the hyperscalers. So that's Amazon, Google, Microsoft. So a 5 year wait on, quality power to be able to power out the stuff that they need, data centers. That's kind of crazy to think about. But it also shows you how outdated and how behind we are in modernizing our power grid. And quantum services has a big play and big impact on that. So for them, they have $39 billion in backlog. So again, $39 billion in the pipeline waiting for them to go through, execute on their orders. And then this is something else I figured out, and I saw that's pretty interesting, is they have 100% growth in load centers. So load centers are a new segment that they have in which they're building microgrids for data centers. So what I first saw was a microgrid is basically a grid that's developed strictly for that data center and strictly for that location. So the microgrid isn't attached to the actual body of the power grid in terms of it's not attached to the segment that Duke Energy has control of or Next Era Energy. It's operating on its own independent grid, which is pretty cool to see and pretty cool that they're able to go ahead and develop that. But also in turn, that allows these data centers to continue to get built out as a short-term solution, right? Obviously, long-term, I don't know how impactful and long-lasting that will be for them to go that route. But for the fact that they're able to go ahead and build these out and be like, hey, here's your own mini power grid for you to keep operations going, for you to still be able to keep scaling and do what you got to do. So microgrids being rolled out and also being, implemented by this company, I feel like is great and is also a pretty innovative way to keep this trade going on for them. And last but not least, definitely mentioned this. I know a couple videos back, because they had pretty down week, but they've had an explosive year. Cannot ignore that. But Micron. So once you've been living on the rock, you know that they're a large memory provider. You've probably seen it all over online, about how much memory prices are for RAM, things of that nature, how hard it is to build your own PC, things like that. So Micron is the pretty much sole provider of memory that we have, and especially um, US based, right? So for they do the high bandwidth memory, only other competitors they have in the space is Samsung and SK Hynett, if I'm saying it right. But those are their only two competitors that they really have. So they pretty much have a chokehold on the market for memory. Who knows who may else come up to try to challenge them? But I don't see that happening anytime soon, especially that they've been having such a stranglehold on the market for so long. And yeah, they just exploded out of nowhere. I see them probably won't have the same amount of growth in terms of stock percentage this year, but they're still going to be a viable player. I think they're still going to be very important to what's going to be built out and still very necessary in this whole AI trade and movement. So what we're going to go into now is the wealth catcher protocol. So it's kind of something I've always been following, this type of protocol, but I think it's also going to be more apparent to keep on doubling down, follow on your foundation, follow on, what got you here, and keep following through on your goals and your boundaries, your rules, and all of those things. So what we're going to be paying attention to for sure is cash flow sovereignty. So companies that fund their own growth. We're not trying to look for anything that's super reliant on debt, or they have to pay back a lot of money, or for them to even try to gain more revenue, they got to keep going more into debt. We're trying to avoid that as much as possible. We want high cash flow, and we also want high cash flow retention as well, right? So again, that's why I would say go for the top two in your space, the one or two that's in that market that you're interested in. They usually have the majority market share, and also there's a reason why. They probably, handle their money the best. You look at their financials, there's not a lot of debt for them, and it probably doesn't cost them that much money to bring that revenue in, right? And then structural demand, businesses that are needs, not wants. I'm a big believer that in that as well. Um, you know, if it's not really moving the GDP of the world, or if it's not, making a great impact on the everyday life of someone, I feel like it's probably something you should probably try to avoid. But again, it's up to you. You're gonna take those risks. But I do look at businesses that operate from a need base who will fare off better and do better in the long term because again, they're needed. They're not, a want. Especially how they structure themselves. They're able to pivot and create themselves into a need. That's also good as well. So something like Meta, who pivoted themselves into a need. Nowadays, you need an online presence in terms of you kind of need to be on Instagram, you kind of need to be on Facebook, and you kind of need to be on all these other platforms to get eyeballs, right? The name for Google, you kind of need to be on Google to go get some recognition, so that people be able to search you and things of that nature. So those businesses probably started off as wants, but then became needs. So definitely have it be a need, or it could develop into a need, right? And then asymmetric value. So again, healthcare I feel like has been ignored, hasn't been loved on pretty much. Something definitely look into. And industrials, but that's another area that we all should be looking into as well. And then what we are avoiding, what we've kind of always been avoiding as well on this channel, and also during this journey that started years ago, the hope trade. Not putting money into a company hoping that it goes up. And again, I always pick on the random companies that's out there in Idaho or middle of Kentucky or wherever they're at that no one knows about. We're not hoping that they one day succeed and make it. We're not doing that. So definitely not doing the hope trade. We're not doing the crowd trade. Crowd trade, it could be multiple things, but like the excitement and the bubble coming around, IPOs coming out, I gotta buy it, I gotta buy it. Or everyone flooding into this certain sector or this certain trade. Not saying you shouldn't join it, be a part of it, but also be wary that the tide can turn at any moment. So I'm a big believer in don't buy at a high. A big believer in don't chase the crowd, don't have FOMO. So that's basically the same thing we're going to keep following for 2026 and beyond. And then again, the laggards, they're not the one and two. I stop praying, hoping that number five is going to become number one. Leave that at the back door. So again, we're not chasing laggards and hoping that they turn around and pivot for us. There's a reason why they're at the bottom of the pile. All right. So we're gonna do a nice little review over 2025, what worked. Obviously, we'll go over what didn't work, and then we've seen already what 2026 will be pivoting to, what we are expecting to work, and how we see them going. And then later on too, I'm gonna touch on the convictions that we have for 2026 and what we do see down the pipeline for macro and for the market, right? So on average, the watch list had an average return of 34%. So that's everything included. That's the ETFs, except for VOO, VGT, and what's the VTI. They're all pretty much the same kind of, so I didn't put them into the grouping for this. So this is pretty much all the ETFs that are like the sectors, the SMH, gold, quantum, silver, and then all the individual stocks. So if you, for some reason, were to buy all those stocks, invested your money in them for that year 2025, you would have got an average return of 34%. Definitely don't recommend doing that because you pretty much are building your own hedge fund at that point. But if you were to do that, 34% isn't a bad return, especially when the market only got 16 to 17%. So give you some insight on how I view things, the strategies and stuff like that in terms of buying points and things of that nature, and also just strictly paying attention to what's going on. Shows that there's some good performance behind that. And we'll round out our Hall of Fame. If for some reason, somehow you're able to pick all the winners on that watch list, which again, very damn near impossible for you to have done it. You would have had a return of 64% if you had picked all the winners on the watch list. So obviously you got Robinhood, great year, amazing year. Definitely looking forward to see what they have down in the future for this year and the next and beyond that, because they have really positioned themselves to be a financial super app. Definitely love the work that they're doing over there, and the turnaround story for them has been amazing. Obviously, we have silver and gold. We know that trade's been going crazy, and then definitely could see it still going up more. Now to that pace, at that clip, probably not, but definitely you can see there's a lot of money piling into these um, metals. So gold, silver, even copper, right? But copper is not on there because I didn't add it to the watch list. I'm probably not going to, but copper is something else that's very underrated that's not being paid attention to as well. To continue on, we got Google, Raytheon Technology, and Shopify. Google, obviously, it was kind of forgotten about. No one really cared about it. Then out of nowhere, they showed us who they really are. They Gemini improved greatly. They had a nano banana. Then they also came with the TPU, which is challenging NVIDIA's GPUs. So Google has really made some noise, and then they are also kind of being viewed as the face of the AI trade. So they had an amazing year. They got Raytheon Technology. We all know who's running the country of America right now, and we all know how he feels about military, how he feels about defense spending. I feel like even regardless of that, if you are a believer of in America and in America's growth, you have to be a believer in America's military as well. So you also gotta be a believer in their defense. So I feel like defensive stocks in terms of Raytheon Technology, Lockheed Martin, General Dynamic, um, things of that nature, those companies, right? There's also others out there that I can't think of right now. But having your dollars attached to them doesn't seem like a bad idea, right? But Raytheon, they had a strong slump for a couple years, got out of there, and now they're up 59% over the past year. Great trade right there, and also great long term hold if you're, again, holding on to what you think is going to be the most beneficial for your portfolio, but also who's benefiting the most for what's going on in the environment, right? Especially over the long term. Then we got Shopify. This is my own personal bias on it, based on how the economy going and how the world's going. I feel like a lot of consumers and a lot of individuals are either pivoting towards second jobs or they're doing the side gigs, the side hustles. And I feel like a lot of people are going towards that entrepreneur route, which I feel like is why Shopify is seeing such a big boom. Also, their share price is reflecting that as well, going up 51% in the past year. A lot of people are trying to find other ways to make money and generate income outside the 9 to 5. And I think that trend is still going to keep on going. And I don't think it's a trend that's going to end. So, still a big believer in Shopify. Then we got SMH. Again, that's a semiconductor trade. Don't know, obviously, who's going to fully win now. I really don't think there's a singular winner that's going to be in there. I think they're all going to win in some way, some facet. And instead of having your money tied to just NVIDIA or tied to just AMD or tied to just TSMC, just buy all of them through this ETF. So SMH, I feel like grabs the whole market for you. You don't have to worry about it. Who does well, who doesn't matter. SMH has been hitting record highs ever since I've been introduced to it. It's been doing that for a couple of years. Even went through a split a couple of years ago. So it's going to keep going up because also, regardless of the AI trade, we need chips in everything. In every device you think of in your everyday life, your vehicles, chips are a factor of it, and chips are a part of it. And then we got Eli Lilly. Again, you know I love the healthcare sector. If I had to pick one name, it's going to be Eli Lilly. And then outside of that, I would just buy the whole sector, XOV, if I had to make another choice. But I feel like you can't go wrong with them as a pharmaceutical company, and you can't go wrong with XOV. But Eli Lilly had a great year, 39%. Then again, we have NVIDIA. We know their story. Obviously, their growth is slowing down. We see a 38% return here. So the years of them probably having that 100% plus returns are probably gone. But then beating the market, I feel like it's still there in terms of them still having that nice growth, right? But obviously, if you got into Nvidia pre 2020, you're soaring now. And then this should be riding it out. Got CrowdStrike again. Cybersecurity is huge for the future. I feel like it's a very pivotal thing in terms of what's going on in today's day and age, and also what we're going on in the future. CrowdStrike is one of the biggest leaders in the cybersecurity market. You do have other names like Palo Alto, Fortinet, sorry. You have those other names, but I do like CrowdStrike itself personally. But you also have other ETFs, I think like Hack or Cyber, CYBR, that you can go into if you want to buy just the whole sector. Do that as well. And then we have quantum computing, a name I feel like we're still too early in. So I just went with the ETF QTUM. And if you had got it at the top of the year and rolled it all through 2025, that's a 35% return for you right there. I feel like, especially for such a volatile area that people really don't know who's going to win in that. I feel like it's one of those things where it's too early to tell, too early to judge. I think the safest way to play that is through that ETF. Then we have JP Morgan Chase, the banks of all banks. If there's anything about financials and the financial markets in terms of banking industry, I don't see you going wrong with JP Morgan Chase, especially with a leader like Jamie Dimon. And I feel like they carry so much weight in that space that it can't be overlooked. If you want anybody else to kind of try to be like, I guess 1A, 1B, or who could kind of like be on that same par with them closely, you got Golden Sachs, you got probably Morgan Stanley, but I feel like JP Morgan is the top dog. And then we have the underperformers, and these are the people who have got kicked off the list. So we're going to start with Sherwin Williams. So I did add them a couple years ago because I saw, I think it was over a 10-year return. They had returns of like a tech index. They had returns just as good as QQQ or even better. But over the past 5 years, the returns have been dismal. It's been not good. And then this past year, they had a 4% drawdown, which isn't terrible, but also it's not something I'm expecting, especially when I see your 10-year window. I saw, you're competing with a NASDAQ 100, right? As a paint company, I'm thinking like, okay, so, there's another indicator of past performance does not indicate future results, right? So they're a prime example of that. But, and also too, I don't believe the housing market is going to go how many people are expecting it to go. I don't see a lot of builds coming out, and also be paying attention. Certain pockets too that prices have been reduced greatly. I even know in my area, prices have been reduced greatly in terms of the market selling off, quote unquote, in terms of there's been a correction in home pricing, right? I had some signs on the street up for new houses being built or new communities. Those signs are now gone, and those houses are not built. So, and then even me, I know you're not supposed to go in there and look at it all the time, but every now and then I do look at the value of my home, and I do see that took a $40,000 haircut on it. So definitely there is some correction activity going on. I'm not saying the whole housing market, but there are pockets of the market that there are some price corrections going on, which is good probably if you want to go buy a home. But in terms of expansion, home building, and also people who are going to be going to do DIY and all that stuff like that, which is the market I feel like Sherwin Williams markets to, the people who are going to go buy the paint, things of that nature, you need that expansion to be able to correlate that to sales, right? And I don't see that happening anytime soon. Then we have Wingstop. Wingstop definitely was a play I had for the growthy section of restaurants, but the way the consumer is so tight right now and stretched, and also the prices that wings just in general do cost a lot of money, but Wingstop, I don't feel like they could get that foot traffic that they need to keep the customer coming in, also keep these margins where they're at. I just don't see it for them. And then maybe it might work out later, maybe it might turn around for them, but the consumer, I feel like it's too uh, strained right now to be able to go to a wing stop and try to get something to eat. And also, too, I might as well just buy some wings at home and do it myself. Like, you could do that as well. I just don't see the price point, and also the risk to the one protein risk. We saw a couple years ago too. They had the avian flu that hit, and then they kind of pivoted to the thighs. So they had all these other things they try to do, but I just don't see it long term anymore for them to work it out and also be a major player in the space. So they're down 60%. You have ADP, so they focus on the human resource, basically function for human capital. They're a very big player in the space. They're like a legacy company. Reason why me personally I'm taking them out is I don't think they have enough time to adapt to how the labor force is changing because they so long have been focused on human capital. And I think this change to human capital is being lessened because now we're pivoting more towards automation, more towards robotics, more towards AI agents. I don't know. I don't see a world where ADP is adjusting to that quick enough when it's been so focused on human capital. They're gonna have to find some way to integrate, I guess, agentic capital into the human capital framework and how that's going to work out for them. Interested to see if they're able to pivot and make that work, but obviously it hasn't. Some stuff has not been working out for them to be down 12% over the past year, right? Then we have a beloved player here, which is Costco. I feel like it's a beloved name across for many people. For them, I took them off because I do have Walmart on the list. I just feel like I'd rather just stick with Walmart. 'Cause I feel like Walmart could still bring those growthy like returns. They got like I think 23% this year, 24% return. Costco, obviously, as you can see here, is down 6%, which isn't too terrible. You're not beating the market. You're down. I don't want to have you in my portfolio or have you on the watch list to picture someone else like, hey, something you should probably look at. But yeah, I just don't see it for them in terms of you got a consumer still paying this cost per year, which I feel like is the only reason why they are going there because I'm paying this money per year. I have to go to Costco. And also, I think they have to do work on their locations because not saying they need a Costco everywhere, but Walmart, I have like three Walmarts, 15 minutes in each direction. Costco, I kind of got to drive like, I think like 45 to an hour to get to a Costco. So I can definitely see that somewhere down the line for them to work on that. But obviously, that's CapEx spend. That's definitely not helping with growth. And then the only way they could really get the growth on their margins is raising prices on those those yearly memberships, and that's not going to go well with consumers as well. So that's why I feel like Walmart kind of has the advantage there because you don't have to pay anything to go into the Walmart. You can walk in there, shop, and buy. And then Walmart has integrated Walmart Pay, the Walmart app, all these other things. You ever done a return through the mobile Walmart app? It's amazing, simple, easy. I've returned something before where they didn't want me to bring the product back. They just gave me my $5, $6 back. I was like, that's amazing. So those type of things, I feel like Walmart has more of an advantage of, and also they are also known for being the lowest price retailer in the market as well, right? So they also have that working for them. But Costco, I feel like it can still hang in there. I still see a future for them, but not as growthy as Walmart, right? So then that rounded that out. So now we're gonna look into macro themes and convictions. So we have macro reality. We do know that inflation's around about 2.7%. And we also do know that Jerome Powell will be leaving his position come, I believe it's May. So we will be getting a new Fed chair. Now with Powell, the question is going to be, is he going to stay on the board to still be a voting member or not? It's kind of neither here nor there. It's kind of important, kind of not really. What's going to be important is who's replacing him, and then that person's stance on, that person's stance on how they view the economic policy, things of that nature. And we do know how the president is. He's pounding the table for lower rates, lower rates, lower rates. It's going to be a good insight and good view to see whoever is the Fed chair. It's two Kevins, Kevin Walsh and Kevin something else, but Kevin versus Kevin, right? Which Kevin is going to, I guess, succumb to what the president's orders are, and then blur that line between the Fed's independence and the presidency, right? Because remember, they're independent entity from the government. They act on their own accord. But if he follows through and does what the president asks him to do, now it's a whole ball game. So games change. But the expectation is whoever the Fed chair is going to fall through on what the president wants at the detriment of whatever it may be, right? Detriment of lowering rates, more money is getting injected to the economy, people are going to do more spending, and then we're going to be in the same cycle we were a couple years ago when inflation was hitting 9%, probably even more, right? So we'll see what happens. But that's what we're looking for in 2026 to see what the tone's going to be set by that new Fed chair. And then key conviction themes in 2026. You already know we still are on this AI trade. I know it's been played out, it's been talked about a lot, but I feel like that's still going to be the theme. It's still going to be the trade, and it's still the thing that needs to work out for all this spending that we're doing. And then we got reshoring. So then that's bringing domestic production capabilities and supply chains back to the U.S. That was a big thing on his campaign to talk about those things. Obviously, we knew that wouldn't happen overnight, but we are slowly seeing some things happen in terms of how, again, all this build out's going on and all these companies are investing all this money. And then, yes, it is kind of a circular type economy in terms of how the money's moving around. But again, for those on the ground level, foundation building, I consider that real money because they got paid. They're going to go out there and execute on it. As that data center gets built up, it's all y'all putting in the server racks. It's all y'all doing the software portion of it to keep that money coming in, to keep those things operating. Quanta Power already got paid. MLM already got paid. Caterpillar, URI, they already got paid. Micron, here's your memory chips. Y'all got paid. We out of there. Everyone else in that stack is going to have to figure out how to keep that revenue coming in and keep that money coming in. That's the next level of the problem is going to be for the software, for the app layers, and those players in the space to keep those revenues coming in from their clients. And then obviously healthcare, healthcare, healthcare. Can't say it enough. I feel like healthcare is very necessary, especially part of your portfolio. I think it's something that can't be overlooked. Healthcare and tech combination. If you can find a company that integrates both of them, again, I love Eli Lilly. But there's other companies too that you can get into the healthcare space that don't have to be Eli Lilly. You got Ecolab, you got something simple as Stryker, you got I'm trying to think of something else. Can't pop on the top of my head right now, but you got those type of names right there. So Stryker, Eli Lilly, Ecolab, those are some great companies to look into. Again, get the XLV ETF, open it up, see all the holdings in there, and you can start picking from there. And then we got to remember for 2026 and beyond what we're doing here, discipline matters. So we're going to deal with volatile markets. We're going to need clarity. We're going to need discipline, very essential steps to you on this journey. And this is not a short-term journey. This is not for a month, a couple weeks. This is, you got to put in your head, this is a multi-decade journey, all right? You building out your portfolio. You building out your children's portfolio. You trying to build out your potentially and hopefully your great grandkids portfolio or your grandchildren portfolio. You got to keep the needle moving, keep the needle pushing. So that's what it's all for right here is stay clear on what you want to do, stay clear in building the foundations out. And then right now you're not going to see it in terms of the dollars moving and all that. But I'm telling you, especially when I look at my son's portfolio, be 4 years into it, the growth from when he was, 3 years, he's turning 4 in the summer. So 3.5 years into it. But seeing the growth from when he was born to now has been astounding. And then knowing that I have another 15 to 18 more years of helping him get that growth and to see where he potentially will be at the age of 18 to 21 versus where I was at 18 to 21. It's mind-boggling to say the least. And then, yeah, build a foundation. And then on another little personal note, being able to, this holiday season, again, hope y'all had a great one. But this holiday season, I was able to help assist my my little nephew get his custodial account set up. I think he's about 9 months now. So pretty much all the younger generations, from my younger siblings to my son, to one of my youngest cousins and my nephew all have brokerage accounts that have money in there that are invested in the market. So it's a great feeling. But again, it starts with you. Build that foundation out, and then it's a great feeling when you start seeing it all go into place, see it all go into motion. But it does take time. It does take a clear mind, and it does take a foundation. It does take discipline. So I want to thank you guys all for stopping by. I know it was another lengthy video, and I am going to try to work on probably a thing where I do probably 10, 15-minute videos because I know some people got stuff to do, places to be. But I do have a lot of information to give at once, and also my schedule is kind of the best way for me to do it. But I will try to work on some shorter videos to try to see if I can make it more bite size and more condensed. Kind of some people got to get up and move around and go and do stuff. But I do want to thank y'all for tapping in and listening in. Again, my email address is right there, thewolfcatcher@yahoo.com. Send me a private message if you want to talk about something personal or in private. The website is thewolfcatchers.com. Again, got watches up there, got articles. I even got merch on there. I got insights. I got pretty much a whole bunch of information on there that you can tap into and to look at. And always remember, catch and secure your wealth. Y'all have a good one. Peace.